Is it better to use life insurance or a Roth IRA when it comes to you trying to have a tax efficient retirement income strategy? Well, I can tell you that is a very unique question that we're going to be discussing in our Tuesday tip, so stay locked in. Hi, my name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center, and I want to welcome you once again to our Tuesday tips, where today we are going to be asking and answering the question of whether it is best to use life insurance or a Roth IRA when it comes to your retirement income. I can tell you right away that when it comes to any of these questions as it pertains to retirement planning, it always depends. And in this particular situation, it will also depend because it's going to depend on your retirement income goals. It's going to depend on your risk tolerance and your overall financial situation. So let's go ahead and jump into our lesson today to talk about which may be better for you, life insurance or Roth IRA when it comes to your retirement income goals. Okay, so let's go ahead and first talk about life insurance. Now, when it comes to life insurance, as most people know, it's primarily designed to provide a death benefit to your beneficiaries. But there are certain type of policies like whole life or index universal life that can actually accumulate cash value over time. And that accumulated cash value can be assessed during your retirement for income purposes. Now, with that being said, let's go ahead and talk about the pros and cons of having life insurance as an income strategy. First of all, the pros. Life insurance can obviously provide a guaranteed death benefit for your loved ones, as we already have mentioned. Also, the cash value that can be accumulated in that life insurance policy will be able to grow tax deferred, meaning that you will not pay taxes on that growth until you actually pull it out. Another positive benefit of using life insurance as an income strategy is that the policy can offer flexible premium payments. So there are times in which your dividends can actually pay for the policy itself. And also you will have the ability not to just withdraw that cash out of that policy, but you could borrow money from the policy tax-free to use that for income purposes or use it for other things that you're planning for, like your kids' college as well. But of course, we also know there are some negative aspects to trying to use any financial product, and it's no different when it comes to life insurance. Of course, a life insurance policy can come with higher premiums and fees compared to other investment options. Another negative aspect of using life insurance as a quote-unquote investment is that the returns of the cash value in that policy may not be as robust as it could be in other investment vehicles. Also, although you can access that cash value through policy loans or just withdrawing that money out of that particular policy, if you do so, it will reduce the death benefit. So, for instance, if you had a death benefit of $200,000 and you decided to borrow cash of $25,000 out of the cash value portion of that particular policy, if you were to pass away without putting that money back in, your family would not get $200,000. They will only get $175,000. Okay, so now let's go ahead and transition to a Roth IRA and talk about how that may differ from using life insurance for a retirement income strategy. Now, a Roth IRA is just simply an individual retirement account. Now, when it comes to the pros of using a Roth IRA, it's very unique in the sense that that money can grow tax-free, and any money that you pull out can also be tax-free in retirement. Another good benefit of using a Roth IRA is that it definitely provides some tax diversification when it comes to your retirement portfolio income strategies as well. It is also to be noted that when you make contributions to a Roth IRA, those contributions are going to be made with after-tax dollars, meaning that you don't pay any taxes on any qualified withdrawals in retirement. Now, let's go ahead and talk about some of the negative aspects of using a Roth IRA for your retirement income strategy. Basically, one of the major negatives of using a Roth IRA for your income strategy is that the contributions to a Roth IRA are subject to income limits and annual contribution limits as well. In 2024, those income limits that if you're a single individual is $161,000, and for a married couple, it is $240,000. What that means, if you make more than $161,000 on your modified adjusted gross income, you will not be able to directly contribute to a Roth as a single individual. That also goes for a married couple who has a modified adjustment gross income of $240,000. They also, in that household, would not be able to directly contribute to a Roth IRA. So that's one of the negative aspects of trying to use a Roth IRA for your retirement income strategy. Also, as I mentioned, when it comes to contributing to that Roth IRA, if you're able to do so, if you're under the age of 50 in 2024, you can only put a maximum of $7,000 into the Roth IRA. And if you are 50 and older, you can put an extra $1,000 into that Roth IRA for a total of $8,000 for the year. So, of course, this would not be the most effective way to build up your retirement savings with those limitations as well. Another negative aspect of Roth IRAs versus life insurance is the fact that, unlike life insurance, your Roth IRA will not be able to offer you a tax-free death benefit greater than the amount of contributions that you put in. Obviously, you can have some investment growth on that Roth IRA, but with a life insurance policy, you can literally be paying, $100 to $200 a month. And if you were to pass away, you can leave your family $200,000 or $300,000, depending on your age and the death benefit amount. So that is a significant difference between using and leveraging life insurance for your retirement income strategies versus a Roth IRA. And one last thing that I want to note when it comes to the constraints of using a Roth IRA is that when you pass those funds on to your beneficiaries, there is a mandatory 10-year distribution rule. So anyone who would inherit your Roth IRA, they would have a mandatory distribution of 10 years to have that money to come out. Now, they don't have to take it out anytime until the 10th year, but due to the Secure Act 2.0, this has become law that any money that you inherited from a Roth IRA must come out within 10 years. And so with that being the case, you do diminish the impact of having that tax-free growth from that Roth IRA because of that mandatory distribution rule. So the overall moral of this video would be that if you are trying to seek both a retirement income and a death benefit for your loved ones, maybe a combination of both a life insurance policy and the utilization of a Roth IRA may be something that you should consider. And of course, as always, make sure that you do consult with a certified financial advisor when it comes to these particular matters. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today. And we will also like to hear from you. Let us know what your thoughts are regarding this particular subject matter and leave any questions or comments in the section below. And if you found this information to be beneficial, all that we ask is that you subscribe to this channel so it can continue to grow, like this video, and share it with others.